Let's start with the first trigger, the Federal Reserve. Not what the Fed has done yet, but what markets believe it might do next. For most of the past year, investors positioned themselves around one dominant assumption: that interest rates would fall aggressively, liquidity would increase, and the dollar would weaken. That expectation pushed money into assets that tend to benefit from inflation and currency debasement, things like gold, Bitcoin, and other hard or alternative assets. For most of the past year, investors positioned themselves around one dominant assumption: that interest rates would fall aggressively, liquidity would increase, and the dollar would weaken. That expectation pushed money into assets that tend to benefit from inflation and currency debasement, things like gold, Bitcoin, and other hard or alternative assets. The US dollar itself just experienced one of its weakest years in nearly a decade. That reinforced the belief that inflation would remain elevated and that monetary policy would stay accommodative. But expectations started to shift. Recent signals suggest the next phase of monetary policy may not be as one-directional as markets originally assumed. Instead of rapid easing and large-scale liquidity expansion, there's growing discussion around balance sheet discipline, inflation control, and preserving institutional independence. Even the possibility of tighter financial conditions matters. Markets don't wait for policy to change, they move on expectations, and when those expectations shift, assets that benefited from easy money tend to reprice quickly. That's what initially pressured Bitcoin, gold, and other inflation-sensitive trades. Not because policy has changed yet, but because certainty has disappeared. That brings us to the second trigger, a structural shift in Bitcoin itself. Years ago, the core investment case for Bitcoin was scarcity. There would only ever be 21 million coins, and ownership meant holding the asset directly. That scarcity narrative helped justify long-term value. But over time, Bitcoin evolved into something else. Today, exposure to Bitcoin doesn't require owning Bitcoin. There are futures, options, leveraged products, ETFs, and synthetic instruments that allow traders to speculate on price without touching the underlying asset. As a result, a growing share of market activity is no longer driven by long-term ownership. It's driven by short-term positioning. Instead of asking, "Is Bitcoin valuable?" many participants are asking, "Can I profit from the price moving?" This matters because derivatives expand supply financially, even when physical or digital supply stays fixed. Scarcity becomes diluted when speculation dominates ownership. Historically, when derivatives volume overwhelms spot ownership, volatility increases. Prices move faster in both directions, and corrections become sharper. This isn't unique to Bitcoin. We've seen this pattern in commodities, equities, and housing cycles before. When speculation overtakes fundamentals, price stability weakens, which leads directly to the third trigger, panic behavior. Bitcoin is one of the most volatile major assets in the global market. That volatility works both ways. Rapid gains attract attention, leverage, and momentum traders. But when prices reverse, fear spreads just as fast. As Bitcoin prices started to fall, narratives shifted immediately, from confidence to concern. Public warnings, dramatic headlines, and worst-case scenarios amplified uncertainty. That reaction itself becomes part of the sell-off. Speculative assets are especially vulnerable to this cycle because many participants aren't prepared to hold through drawdowns. When price drops threaten leverage, margin positions unwind. Forced selling accelerates losses. This type of behavior isn't new. It's psychology repeating itself. And while Bitcoin is often the first place volatility shows up, it rarely stays isolated. We're already seeing similar dynamics in other speculative areas, particularly in technology and AI-related stocks. In the previous cycle, companies were rewarded simply for announcing aggressive investment plans. Debt-funded expansion was seen as bullish. Now, investors are asking different questions. Where does the cash flow come from? When does profitability arrive? What happens if growth slows? That shift in mindset changes valuations. Projects that once benefited from optimism are now scrutinized for risk. This is what happens when liquidity tightens and uncertainty increases. Speculation gives way to selectivity. That doesn't mean innovation stops. It means capital becomes more careful. And this is the broader lesson. Markets move in cycles. Assets rotate in and out of favor. Volatility doesn't mean something is broken. It means expectations are being recalibrated. For long-term investors, volatility is not an enemy. It's information. It reveals where excess has built up and where discipline is returning. Those who chase price tend to panic during corrections. Those who understand cycles use corrections to reassess value. That principle applies to Bitcoin, stocks, real estate, commodities, every market. Understanding how money flows, how expectations shift, and how psychology drives price action is far more important than predicting short-term moves. Because when the noise fades, fundamentals always matter again.